Good evening again. Learn, grow, invest community. Welcome again to another stock review. I like to welcome everybody that is tuned in to our what will become more frequent reviews of the companies that not only are on the Jamaican Stock Exchange but more than likely in the Caribbean and the world as we grow. So once again, as you normally know, we bring the meeting to order and the Learn, Go, Invest community is a community built on faith investing. So we always like to start off with, putting the meeting in the hands of the Lord. So we're gonna do that now. So Almighty Father, we thank you once again for bringing us all here together in this fellowship and discussion and presentation. For the information that is going to be imparted, we ask that it be received, it be understood, and it be beneficial to those who are currently viewing. We give thanks again and all things we pray. Amen. All right. So with that, we always have to do our housekeeping. Um, Note or disclaimer that this is not financial advice. Never is. We're not financial advisors. We basically just have a passion for investing, and we believe we see things about a particular company are based on the work that we do. We see what we see and then we present it as it is. So it's for informational purposes only. So as was the last time, I'll just go through quickly what the format is going to basically be. So we're going to have this stock overview of itself, of the company that we're reviewing. And then we're going to talk about, well, if the company has competition, we're going to highlight who they are, the industry that they work in, and then we get into the meat of the matter, which is their reports. We're going to look on their annual and their quarterly reports. Then we look on the price of the company in terms of what it's selling at, their volume, and then we look at any kind of upcoming news or events. So with respect to how the last one was done, I'm going to switch it up a little bit. For those, and I encourage you all to basically, if you haven't subscribed as yet, please subscribe. Also, like and share this video and other videos that we have done because we seek to improve, right, the financial literacy of the landscape of not just Jamaica but the Caribbean, etc. And every like, every share helps to ensure that it gets seen by more persons, right? So as stated, for those who have seen the last review, which was Jamaica Teas, this one is going to be done a little bit differently, and you'll see in short order. Here are some improvements that have been made in terms of how it's done, so we can get basically right into it. So today's review, we're going to be reviewing the company Fosrich, right? Uh, I'm going to share my screen so we can go through it. And unlike the last time, we actually have also a presentation. 1 second. So let me make sure that everybody can see. There we go. All right. So, and I'm going to just put us into, I'm going to make it a little bit bigger. If I go, there we go. All right. So, who is Fosrich basically? So, I'm too far in. So, who is Fosrich basically, and the company that they are? So, the company Fosrich basically distributes lighting. They do electrical products, solar energy products to Jamaica, and the company currently does the boxes and panels, as you can see, steel wire armored cables, sorry, wiring devices, bulbs, etc. And it also supplies ceiling lighting, standard lighting, outdoors, fans, other electrical supplies, and industrial products that are used to build hotels, in the bauxite plants, in factories, housing development projects, and they also offer training services. And the company also sells PVC pipes and fittings and it serves both retail and commercial customers. So there we have in terms of who Fosrich is, what they do. It's a wide gamut of things, but primarily as we go on, you will actually see that they're pretty much getting ingrained in Jamaica of itself in terms of the bigger side, in the commercial customers, and it will be discussed or presented shortly, right? But just think Fosrich, everything electrical, and also things solar, and that's very important because that particular product of solar energy is a very huge step forward for them in terms of where the company plans to be going. So taking from their report, the annual report that was done 2020, I thought this was very relevant for further overview of the company and where they are going in terms of moving forward. So in their chairman statement by Marion Foster, she states that what Fosrich is, it's said that the success of the organization is dependent on its culture and the people and the talent within it, and Fosrich is no exception. So they have significant strength and depth within company, with several of their team members boasting long tenures. They share core values of respect, high performance, knowledge, fair competition, and excellent customer service. The company has maintained its great relationship with its Fortune 500 partners. So that's not even Jamaican, but outside globally, of Philips, Siemens, Nexans, and General Electric. And more recently, and this is a key one to pay attention to because this is actually paving the way for where they go into the future, Huawei, which is photovoltaic fusion solar inverters. And it is their aim to continue to build on those relationships and improve on the products offered to our customers. She further goes on to state that Fosrich is determined to continue on its growth path, not only with its present business segments, but also with the addition of our most recent, the signing of a 4-year renewable contract in the fourth quarter with the Jamaica Public Service. So if everybody knows, JPS, monopoly on light and electricity in Jamaica. And here we have Fosrich putting down a 4-year renewable contract to basically do certain segments of business with them. And what are they? To repair yearly over 1,000 of those approximately 40,000 transformers in its power distribution. So that would be something very key to, if we can find it in the going forward in the company financials, identify how much revenue they stand to gain from that part of the business. Additionally, all pieces of equipment have been acquired and installed, and the factory will be in full operation by the end of February 2021. Well, we're in February, we've already gone past that, so their factory should be fully up and running. Fosrich is also expecting increased revenues from the expansion of the PVC segment of the business in the manufacturing of PVC fittings and large diameter pipes to fill the demand locally. So that's more I would like to believe that would be on the local sector, right? At that point, they would basically be, or the retail sector, as they call it, more than the commercial. Or it could be it is more likely a bit of both, right? Uh, the production for that part is expected to begin in the latter part of the second quarter and in the third quarter, respectively. We are confident that these investments will yield a great return for our shareholders. Now, note, as I said, reminder, this was taken from the annual report of 2020. Fosrich has not put out their report for 2021 as yet, right? We'll talk about that later on. But just bear that in mind that all of this is either done or was ongoing at the time in the period of 2021, right? So moving on from there, we would want to identify who are their primary competitors, basically, because the next segment, and unfortunately, there isn't, from what I was looking at, there isn't an actual company that is listed on the stock exchange that is a direct competitor to Fosrich. However, company of itself has falls in the retail sector. And as such, there are other companies that are there. So I guess the only closest one in the retail sector doing anything remotely close to them is Tropical Battery, right? In terms of the fact that they deal with the making of or putting together of batteries, sale of batteries, etc. And most recently stepping into the solar realm as well too. So that might possibly be a consideration as part of their competition going forward in the future. But they fall in the retail sector, and the retail sector has a myriad of different other companies made up of both food, distribution, automotives, etc. Right? And we'll show that in terms of how they relate to that sector later on. So moving forward from there, we get pretty much into the meat of the matter of who Fosrich, how Fosrich has been basically performing, right? And we take a look at their company financials. Now, as I said, there is a difference of what happened in the last presentation where we did Jamaica teas, and I was showing a lot of numbers. But this time around, I decided, thinking that a graphical presentation will be much better. You're going to have performance graphs of all of the various ratios, or most of them at least, so because we don't want to lose the audience, of the ratios that are relevant to the company. So let's go once again. How do we go through the financials? There are three financial statements. There's the balance sheet, there's the income statement, also known as the profit and loss statement, and there is the cash flow statement. For those who know my reviews, I pay very keen attention to the cash flow statement because it's the one statement that has actual cash going in and going out of the business. In the other statements, for instance, the income statement, you can have things that are booked that a cash payment hasn't been made on, but it is still seen as revenue. And that is very important to note and remember. So I like to look on cash because that gives me a better idea or heat map, if you want to use that term, of the true functioning and performance of the company. Now, with respect to the cash flow statement, when we get to it, it's very straightforward. The cash flow statement is broken up into three parts. There's cash flow from operations, there's cash flow from investing, and there's cash flow from financing. Operations, straightforward. It's just what is being done by the company in terms of generating the revenue. Investing, it's normally things such as what they're going to buy. So, for instance, if they're going to improve their property or their plant or their equipment, that goes in investing. And the financing part is paying debt, paying dividends, etc. So very straightforward. We'll keep it that way and keep it that simple, right? So what we're going to focus on first now is the balance sheet, right, and the charts there that follow that. So for the balance sheet, so I might need to make this a bit bigger. 1 second. So as I said in our other presentations and the last one most recently, when companies are being reviewed, they normally look on how debt works for the company. And basically, when you do certain ratios, it is normally stated that you should compare the company to another company. But what happens when you run upon a company like Fosrich and you do not have a comparable entity to do so? I still firmly believe that these ratios need to have some type of threshold that set them up so that the company can be valued, analyzed on its own. So for me, we're going to keep this one simple. The last one was numbers and it showed, and I had different charts about if this was red or this was blue. But this time, the picture should be straightforward. When it comes to debt, to the debt ratios that we're going to go through, having your debt going up is not something you favorably want to do, right? Or want to see. You'd prefer that it be going to it be going downward, right? So as we look on the company's debt to asset ratio, basically, so this is how much of debt makes up assets. We can see that Fosrich has been steadily growing that number. Now, the threshold that I have for this, it should actually be done like at 0.2, but they are way out there. And it actually shows up because in subsequent charts to come, you'll see that Fosrich actually has a lot of debt, right? So this is going to be the common theme for Fosrich and their debt, that your debt to asset is going to show that it's not only high, but it's trending upwards. Then you have your debt to equity also being higher and it's trending upwards. And everybody should understand that equity is basically what is to be paid to you in terms of that shareholder equity or the general equity of those invested in the company. So if the company has an insurmountable amount of debt or a large amount of debt, then it's going to be very difficult for them to pay any returns out to you because they need to pay down on their debt first. So that's already two things: debt to asset, debt to equity, that are both on a trending rise. And as you can see year on year, as I said, we don't have their 2021 financials as yet, only up to 2020, and then we have the 9 months for 2021 and compare that to the 9 months of 2020 for basically each of these charts. And you can see that the two are pretty much lockstep. Now, let's give them a bit of leeway in the fact that 2020 was the year of COVID. So, when COVID was at its worst. So pretty much it can be understood that a lot of things happened in Jamaica, that not a lot of commerce was going on. So, it might be that they had to basically ensure that that in order to manage everything, they had to do some kind of data, especially for expansion and so forth. But another key factor will come down to about that is in the cash flow statement, because as I might have pointed out in previous um, videos that I've done, cash flow is the lifeblood of the company. Having a lot of cash means that when things like COVID hit, right, what they call black swan events, you can either ride them out or you can expand. Not having cash means that you're more than likely going to have to either come back to the market for more capital in the form of, if they're since they're already listed, it would have to be an APO, additional public offer, right? Or they're going to have to undertake debt by getting a loan from a bank or so forth, right? Those are the only two ways that more capital flows into the company outside of them doing what they're supposed to do, selling products, generating revenue. So moving on from there, we have the debt to capital ratio, and we have the debt to earnings before interest, taxes, uh, depreciation and amortization, right? So that's slipped me for a little bit. So those two are also very, very important ones as well to look at. So when we look at those, we can also see now capital. What is the capital part of this? The capital part is actually the money that, in terms of how they put their on the balance sheet, how they have spent their money, basically, or what portion of it is going to be basically spent on debt. And as you can clearly see again, once again, lockstep, it's on a trend upward. It's basically the same in the 9 month period the year before versus now. On the earnings before interest on our EBITDA, as it's called, so I don't have to say it again, you can see that it clearly went up even higher for the 9 month 2021 period. Something to remember, because when we get to the income statement, and more so when we get to the cash flow statement, that is going to become evident as to, in my opinion, as to why it's something to be very, very careful of and make sure that it is, I won't say, I don't want to use the word concerning, but it's something to be mindful of, right, going forward, about this company, about the company in general. So debt to capital rising, debt to EBITDA also rising, right? And when we go past that, we now reach the point of cash. and how cash in the balance sheet. And basically, these ratios we're testing to see how much of debts in terms of the liabilities. This deals with current liabilities is part of their other areas. So the acid test ratio basically is looking at the difference of current assets taking with the exception or the removal of inventories against current liabilities. As you can see, this on this hand, we want this part to basically be in a trend upward, basically, because it would be that if the company is doing good for that, um, if the company is trending upward in that number, then that's a good thing, right? If it's not trending upward with respect to these ratios, there are three ratios. There's an asset test ratio, there's a cash ratio, and then there's a current ratio. Cash ratio is basically cash balances, which is found in the balance sheet against current liabilities. And if the company is normally when you see a big amount of cash in that or a cash ratio that is high, it is not really indicative of either the company getting a lot of money to basically do something later on or holding back on cash to basically do something such as expansion. Or maybe they want to pay off a debt that is upcoming, a big debt that is upcoming as well. So presently, as it stands, as you can see, for these two figures for the asset test ratio, which is also called the quick ratio, and the cash ratio of itself, the trend is up. Why is the trend up? Because we've included the 9 months for 2021. And as you can clearly see, in the 9 months, it's recovered itself based on where it was in the year 2020. For the entire year, it was really low on the cash ratio. And now it is up even more. That is what? More than two times up for the 9 month period. So I'm looking forward to Fosrich's financial year to see what it looks like because that that should be it should show some decent turnaround for them. On the case of the asset test ratio, also the same thing prevails. That's the 9 month period, much higher. So this bar for the December 2021 period, I would expect that it should be higher than the December 2020 period for sure. But I would prefer to see that the bar is higher than the December 2019 period. So that's something to look out for and to be mindful of. So moving forward, the next ratio that we would deal with is the current ratio. Now, for the current ratio, this is straightforward. It's a difference or the division of the current assets from current liabilities. This you also want to see going up. Unfortunately, for the year-on-year chart, year-on-year comparison, it's been going back down as of 2019. Again, let's attribute COVID to that. And when we come to the 9 month period, it's going back up, right? Now, financial leverage. This one is a bit tricky. Why do I say it's a bit tricky? Because financial leverage basically is a ratio that you actually want to be going down. It's basically looking at how much of equity, or should I say for the assets, how much of it is actual equity. And you want this, you want this to basically this figure, you need to have that going down. And currently for Fosrich, it is on a continuous upward drive, which is something that you would prefer not to see. Or at least I should say I would prefer not to see because my thresholds, when I look on my thresholds for that, it needs to be below 2. And currently, as you can see, if you map the chart where it is, you can see that the financial leverage is easily above 3, right? So we need to be down by 2, and we're all the way up at 3. And even in the 9 months, I mean, it's coming down in the 9 months. That's good. So let's see what happens when the financial year is put out and if it comes down even lower. So that's basically the balance sheet. And just for and basically with that pictorial, what I'm going to do is I'm just going to do a quick share to show you guys, for those who were familiar with the last one, but those who didn't see it, I think it's fair to show them that when it comes to the company where I'm getting this from is here with respect to the ratios. So those who saw the last one, I am concerned overall about Fosrich because it's not going to be, it wasn't depicted on the graph, but based on the thresholds that I used, everything for Fosrich was red. Their current ratio is pleasing because it is blue. It has been consistently blue. They've held it as that. The thresholds that I use for the financial leverage are cautionary and rising. And I believe that if it hits 4, it would become red as well too. So for those who basically to get a better understanding of how those graphs were created and where it's coming from. And of course, at the top is basically just the company financials extracted, and then the ratios are calculated below that I'm looking at, and then my thresholds are put in accordingly. So moving forward, we now move to the next section, which is the combination of the income statement and the cash flow statement. And why is it a combination? Because a lot of the ratios that are calculated, or indicators, I should say, that are calculated on that are calculated technically together. You need parts of net profit to be connected to free cash flow or to be connected to equity, etc. And it comes over on the other side. So I decided it would actually be more prudent to link the two together. And when pulling out those ratios, it's easier to do the calculation. So let's go forward again, once again, with the graphs that were generated from this. Oh, I apologize. 1 second. One last set, or is it two? Two. Two sections that are left. I'm sorry about that. There are actually two very important ones that were left in the balance sheet. These are actually, they were spoken about earlier on, but putting them together is another picture that is very good. Equity, shareholders' equity, and its growth is very important, as we spoke about. Notice that equity growth in the chart on the left, or the graph on the left, shows that it has been coming down. In the 9-month period, it has shot back up for 2021. Let's see what happens when the financial year for 2021 is given. But as it currently stands, it was on a downward trend. And it also showed that the equity growth rate, which is taken from that, was also on a downward cycle as well. So we will see what happens, expectantly looking forward to the December 2021, how this turns around, should turn around. And then a good example, as I've shown you, of the other debt to something ratios, debt to asset, debt to equity, etc., of why they have so much is because they simply have a lot of debt, and that is seen right here. This is the equity of the company, and basically, in my studies of analysis, one of the things that is not favorable or wasn't favorable is that a company must have large amounts of debt outsizing its equity. So I like to look on companies that this graph is under reverse, where the equity, which is in blue, is above the total debt, which is in orange. Here you have Fosrich with their debt slowly outpaced, not even slowly anymore. It started slowly in 2016 and in 2017, but then it just really ran away. Now, easily, if you all take a look at the notes of Fosrich in their financial statement, you will see a section of all of the different loans that they have outstanding and all of the long-term loans that they have outstanding. This is indicative of where it's coming from in terms of that debt. The next graph afterwards will even show you how the two lockstep together in terms of assets and liabilities, because right after that is how their assets compare to their liabilities. Their liabilities is also known as total debt. And as their assets have grown, so of their liabilities. The good thing is that their assets still, and this is not just current, but all assets, so it's non-current and current. So if they needed to pack up the company and sell it, at least their assets still outstrip what are the liabilities. I still am not comfortable about it, but I like that this is the situation. But this graph for me, the one before that, which is the equity versus its total debt, is the one that I pay keen attention to as a shareholder. I don't like to see this. I like companies that it's either in line or even more so it's below. That is a key factor for me. The last one in the balance sheet set of graphs is the cash at the bank and cash and bank balances. This you definitely want to be seeing going up. And as such, it has been coming down from 2018. We had a large amount in 2018, following 2017, and then it slowly started to progress downward. Again, let's chalk this up of 2020 to COVID and what has happened. Because as you can see for 2021, it's on its way back up, right? So let's again pay keen attention and expectantly to what they do for their financial year 2021. So we move on from the balance sheet, and now we move to the income statement. Or do I have something more for the balance sheet? Oh, I do. That's my apologies again. Last thing for a company like this on the balance sheet. Is it the last? Yes, it's definitely the last one. The last one for the company, for a company like this that does the sale of products, right? Note that this is what they do. They have to sell all of the different photovoltaic batteries, etc. Two key things to pay attention to on the balance sheet are the payables and receivables. Both you want to see going well. The payables you want to see going up, but they need to be paying out more. And you definitely don't want to see the receivables increasing. You want to see that going down. Because what does that mean? Basically, if the receivables are increasing, it means they're not actually booking. They're booking money, but not, or should I say, they're booking sales, but they're not actually booking payments. Like they're not being paid like that. So again, chalk it up to COVID. But this is really huge. Like here we have December 2020, it's just 250 million in receivables. But then for the 9 month period, it's over 450 million. This definitely, we want to see this come back to this level here. Similarly, payables for 2020 was really high, and it's coming back down basically. So two things also that are very important in the balance sheet that you want to look at. And pretty much there are no indicators for this, by the way. This is an eyeball. There's no ratio threshold that you can hold the company to. It's simply knowing that you want to see which one is going up and which one is going down consistently over the years for companies that are selling products, right? And are making something for sale or distribution. So definitely no, we are definitely done with the balance sheet. I know that for a fact, and we're moving on to the income statement and cash flow. So with that being said, I like to put together the combination of things from the two, right? So, for instance, you will find things about revenue in the income statement. Sales and revenue is the first line item in the balance sheet, in the income statement. Apologies. And then all of that translates into profit or net income. So, either net loss or net profit. Net profit or net loss is found now as the top line item in the cash flow statement. So, bringing it all together, right? What we have is a combination of, I like to look on revenue, but revenue doesn't tell you that all of the stuff that was sold was actually paid for. Nonetheless, let's take it for what it is right now. So revenue, I compare revenue to receivables. Remember what I said. I need to see that if revenue is increasing, also the receivables are increasing, because that means they're booking their pay, their sorry, it's yeah, it's increasing because they're booking their payments, right, on things sold. And then I like to look at as well the line graph is the accounts, the receivables in comparison to their sales. So there are three different things going on in this chart put together. There's a sales and revenue, how they've been doing. For sales revenue, how they've been doing year on year. That's the blue chart. There's the receivables, how that's been doing in orange. And then there's a combination of that sales and revenue to the receivables on the gray line chart that you see, which is flat, right? Ideally, what you want to see is that is going up for the gray, going up for the blue, and also it would be the same going up for the orange, basically, right? So to have that. And what we have now is a situation of outsized revenue, not that much receivables, and then in comparison, when you put the receivables to your sales, a flat chart, a flat line. This is going to become very evident in short order in terms of what is going on when we look deeper into the actual cash flow statement. So remember this and just hold it in mind as we move forward, right? The next one is how revenue stacks up to what is called enterprise value. Now, what is enterprise value? Basically, if the company was decided to sell itself tomorrow, some investor came and said, I want to buy a company. What's it worth? They would give them a figure, basically, of what enterprise value is. And enterprise value takes into consideration it takes into consideration debt. It's the, let me just get the correct formula for you guys. 1 second, because I like to do that to be absolutely clear on that. So what it is, it's the market cap, which is what we determine as the price. So the current stock price of the company multiplied by all of the shares that the company has outstanding. So the market cap plus the inclusion of their debt, and we remove their cash, the company's cash, to get the enterprise value. Pretty much, that's the rudimentary calculation about it. And you can easily find that calculation in at investopedia.com. So just type in enterprise value. So basically, not sticking on this chart much longer, we notice that revenue is increasing, but receivables isn't, and receivables in comparison to revenue is flat. We move on to the revenue versus the enterprise value. Now, this is a positive indicator, because at least the enterprise value is still higher than the sales and revenue, but it could also be seen as a negative that we have basically overbooked what the company is truly capable of, right? But still, it's a positive that you actually would want to see. It's a positive that the enterprise value is there. What you really want to see, though, is you would love to see that revenue is what happened around 2016, where it was closer to each other, right? And as such, the comparison of its enterprise value to its overall sales is also, this is not flat, this is actually going down a bit between their 2019 to 2020 period. It shows that it's going back up in the 9 month 2021. So let's see what the end of the year says, because this would be I mean, as a long-term analyst, and if the company is planning to sell themselves, it's something to think about. It shows the growth of the company in terms of how they're doing. So you want to see that the sales is starting to catch up with the enterprise value. So in line, what we could take away from this is that we kind of overpriced the company in terms of market value. And I'm going to say actually that in my calculations, we have overpriced the company based on what I have. And I'm going to show that later on when we get to some price information in the price section. So moving on from that. So we've done revenue. The next thing up again is one last item for revenue, which is my favorite. As I said, I like cash flow. So this is a combination of a part of the cash flow statement and the income statement being put together. This is revenue in comparison to what is called free cash flow. Free cash flow is a simple formula. It says cash flow from operations deducting the capital expenditure, which is normally the major line item is property, plant, and equipment. And then what you have is a ratio that is done, or indicator that is called free cash flow percentage. And that's normally against sales. So that's another 3 indicators being done on this one graph. And it's very important. If you remember nothing else about a company, at least from me, if you're going to do that, a company with massive amounts of cash is in my opinion, is a gold mine, because that means that they're doing what they're supposed to do in terms of generating. However, they generate revenue. A company with massive amounts of cash on the line item of how that revenue is generated, whether it be cash flow from operations, cash flow from investing, or those are the 2 main ones, by the way: cash flow from operations or cash flow from investing, right? However, they're generating that revenue, they better be doing well at it, so that at the end of the year or quarter or whatever period we're looking at, the cash at that period, at the end of that period, is not only positive, but it's also growing. As you can clearly see with Fosrich, with respect to their revenue, they're booking a lot of revenue. As you can see with the blue line, looks great. Remember what I said, not it does revenue by itself doesn't give a picture of what is being translated into cash. And with that respect, their free cash flow is negative, and that's concerning. And further to that, their free cash flow to sales is also concerning because that is also dipped and it has come back up and it's now flatlined basically. When I show you the thresholds that I use, well, not the thresholds that I use, but what they indicate in terms of the color coding shows for this, because the, the color for this is easily supposed to be red because all of the free cash flow is below zero. That is not acceptable, right? Not even in the 9 months. And remember, as I said, if a company doesn't have cash, they're gonna have to, in order to come back to keep operations going, when things like COVID happen, etc. There's only two places to come back to. They're either coming back to the market with an IPO if they're already listed, or if they're not listed as an IPO, are they going to get debt from a bank, right? Or some kind of lender, right? So that's that for revenue comparing to free cash flow. The next one is market capitalization. Now, this is the information, or should I say, the indicator that we, as the investor, we cause. As I said, market cap is the price we determine for the company, the market price, multiply that by all of the shares, and that gives you a figure. Now, when you decide that you're going to pay for a company, you should understand that if the company's price is much higher than the free cash flow, that is not something favorable because it's, at least in my opinion, because that means you're going to be overpaying for the company. In this situation, again, free cash flow is negative. Your market cap has been steadily increasing, and as you notice, the free cash flow to market cap has been on a steady, not even a steady, continuous decline from since 2016, back up and right back down again. And it also shows that in the 9 months comparison, 2020, 2021 is the same thing too. So let's see what happens in 2021 for the financial year. I don't expect that this will change much, but all the same, it is that. So I'm just going to drop off of that for 1 second, and I'm going to show you. Let me just show you the document of itself in terms of that part with respect to free cash flow. So everything here that we're going to discuss is free cash flow. So we're going to discuss some more stuff. So free cash flow of sales, free cash flow of market cap. We just spoke on those two. They're both negative. They're both negative in the 9 months of 2021. They were positive the previous year before. This is concerning. This is concerning to me, right? And we're gonna talk. We have enterprise value of sales. I spoke on that one in the earlier chart. You have at my thresholds that I use. That's negative. That's in a negative light. It's not a negative number, but it needs to be higher, right? It needs to be lower. Apologies, right? Then you have some other ones that are there. We'll get to that in short order. But I just wanted you to see in terms of how those charts were being created and what thresholds were being used. So here we have, I spoke about the enterprise value. And the reason why it's blue is because the enterprise value is higher than the market cap of the company, which is up here. And even more importantly, if you take the enterprise value and you go get it down to a per share basis, I have that as blue because enterprise value is higher at a per share basis, higher than the market price, at least at the time of 2020, that is. So when we get the new financials, we'll see where it stands at that point. But at the point of 2020, when it was calculated, it was in a fairly good light. If you notice at the 9 month period of 2021, it's $12.70 at the enterprise value versus at the time the market price was $8.11. We're now up to $14. We'll get to that in short order about Fosrich. So something to remember if the company is possibly as well overvalued with respect to their enterprise value, right? So moving on from there and back to the presentation. we move on to our equity. So this is a combination of, we bring the equity over from the balance sheet because it needs to be done, versus the return on equity, right? This is very important to you as a shareholder. You want to see this going up. And as such, they're doing just that. It's improving. Um, the threshold that I use for this is actually 15%. So as it stands for the yearly figures, this is less than 15, so it would be negative. But as you can see, for the 9-month period, it was 16, so that would be positive, right? So this you definitely want to see. In comparison, if equity is going up, you want to see return on equity also going up, which is the trend line, which is the line, the orange line that is here. It should be going up lockstep with each other, right? So that is also going up. So that's favorable. And then you have return on assets. Return on assets, you also want to see that going up. And it was going up a lot in the 9-month period. Now, in my chart, though, this is still not positive based on the threshold that I use because it's higher than what is here. So this will be red. And I'll show you that when I come off it, that will be red. So thereafter, we have income. So before I touch that, let's do the chart. Let's jump right back into the and show the returns on, etc. So here we have return on equity. As you can see, based on my threshold I said it was 15% I want to return on equity. It's red because it didn't hit that. But it's been growing, so I can't knock them. Steadily growing every single year, as you saw in the chart. A return on assets, I also want it to be, I think that threshold is, see what it says about that. That threshold is supposed to be greater than 7%, which it is not, right? So we need that to improve as well, too. Right? So return on assets, return on equity, we're looking for nice things from Fosrich to basically improve and keep going up. So thereafter, we move over to the next set of information, which is going to be about net income or profit, basically, and what they've been doing with that. So anything about profit, you want to see that going up. So those charts that we're going to look on, this is net income. So they have booked. This is a comparison of their net income to their revenue, and in conjunction, based on the two combined, you get the net margins. This is concerning because Fosrich apparently makes a whole bunch of revenue, but they make very little net profit. So, as you can clearly see, the revenue bar is in orange, the net profit bar is in blue. You want to see a more balanced bar in terms of this. And I chose this one because I thought this depiction did it best than a side by side, which you see on the next one over, and we'll talk about what that is in a short order. Because this goes hand in hand that I would like to see that the company is booking more net income in comparison. What this generally tells you is that this company is losing a bunch of money to expenses or some other line item as we go down the income statement, right? In terms of they're either losing it at their cost of sales, in terms of our cost of revenue, which is the next line item right after the revenue line item, which gives us our gross profit, or they're losing it somewhere down, so they don't have taxation. So they're losing it to maybe finance costs or something else. But this is directly found in the income statement. If you look at the income statement, just start with the first line item, which is revenue, and then look on how revenue starts to get deducted or starts to get lessened or improved. That's how this chart came up. This chart that goes hand in hand with it is the one on the right, which is a comparison of the gross margin to their operating margin. So their gross margin, which is the one in blue, it's normally standard to see that a company has way more gross margin or more gross margin than operating margin. Because operating margin is everything after you take out the cost of revenue, and it has to do with what is called selling, general, and administrative expenses. It's called SG&A when you seek to calculate operating margin number. But as you can clearly see, I actually want to see that operating margin is growing just as the gross profit margin is growing. And if you notice, a lot of times when it's spoken about in terms of reports, they always talk about, oh, the revenues, it has grown 20% or 100%, and they receive a lot of gross profit margin has grown by about another 50%. That's not the true, in my opinion, that is not the true litmus test of the viability of the company. Because at the end of the day, for you, the shareholder, there's only one place that payment to you is coming out of. Well, unless you're getting capital gains from the market price going up. But from the actual company, there's only one place it's coming from: net profit, right? If they're to pay you a dividend. So I want to see that the operating margin, just as the gross profit margin or the gross margin, is also up high, which is not the situation here. But as you can see, it was better in the 9 months of 2020, and it is dipped back down for operating margins in the 2021 period, right? So for me, that's something concerning, or very concerning. And there's a threshold for this as well that I use. So their gross margins are going to show blue, and their operating margins are going to be in red. Easily, I can tell you this already when we get to the chart. So moving forward from there, this is the other part of. I showed you this one already. So this is it as a chart. So compare the market price to the enterprise value per share price to see if I think the company is at least undervalued or overvalued based on if the company was to be sold tomorrow in a takeover or something, for instance. And I like to see this. I like to see where the enterprise value is higher than the market price, right? And that has steadily been up there. So that's one indicator. And then the other one after that is the company growth rate. Now, this is the sales figure, and what it's looking at is the change of sales year on year. And as you can clearly see that as sales have been going on each year, it has dipped in comparison to 2019. If you put 2020 to 2019, the growth rate has dipped. This one is 2019. Sorry, let's go back. This one is 20. So December 2019 is a growth of 2018 to 2019. 2018 is a growth of 2017 to 2018, and 2017 is a growth of 2016 or 2016 to 2017. So as you can see, this is the growth rate of the company. Now you want this to be going up. It was. It's dropped down. Let's see what happens for 2021. As the 2021 9-month period, it had gone back up. So my expectation and my hope is that when the 2021 period is put out, it will actually be up, right, further. Then from there, we move to is this. I believe this will be this is the last slide in the income statement, cash flow statement combination. And what it is the earnings per share. Everybody knows what that is. Basically, it's the net income on a per share basis. Earnings per share versus the earnings per share growth rate, right? And I also want to see the two of them going up. For the EPS, you can clearly see that the EPS has been growing. So when persons get up and say, when you hear the apologies, when you hear that the EPS is growing year on year by 10%, and then you see a chart that says, oh, we made earnings per share and it moved from 13 cents to 36 cents or 25 cents or whatever number. This blue chart of how EPS is growing up on a steady upward climb is something that is, for a value investor, this is definitely the trend that we want to see. But we also want to see a trend where the growth rate is also growing and not flatlining or dropping off, right? So what this growth rate line, which is in orange, is saying or illustrating is that it's basically, even though it's growing in terms of the number for the EPS, which is the figure on the left side in terms of how much it's growing by, the percentage growth is not the same. It's less. So it's actually coming down. So now it's flatlining, basically between 2019 and 2020, right? So that's pretty much it for putting together the three sheets and what I look on. Let me pull it back to the pull it back to the actual spreadsheet that generated that so that you can see. So here we have earnings per share, and this is earnings growth. These two lines that are here, and I think I need to zoom this so you can see it better, right? And as you can clearly see, 79% down to 32, down to 18, down to 17. Now it's zero because this is where I started calculating it from, right? So of course I didn't have 2015 inside of it, so of course it's calculated on itself. And I have other indicators, as you can clearly see off to the side, that are very important to me, like free cash flow and so forth. This is also another important figure that I didn't put because it's at a more advanced level, but it's still something to know, for those of you who want to actually delve into it. The free cash flow per share basically is something that is in lockstep with the earnings per share. Remember what I said about cash. If the company has good free cash flow, then the company can do many things, ride out storms or grow. You want to see the free cash flow being very close to the EPS. The fact that the free cash flow per share is negative and the EPS is positive means that your net income figure that you got is not all about cash at all, right? So that's the nitty-gritty of getting into the company of itself, past just the regular line item of just revenue or earnings per share or assets increased by X or so forth, right? It's getting deeper down into the viability of the company of itself. So with that, we move to the next section, moving off of the company financials now in any kind of way, and we now move to price. So after all of that is being said, with an understanding of those things and having seen them, what you can determine at that point in time is, in your opinion, is the company undervalued, overvalued, or in between? So they normally say overweight, underweight, or market weight, right? Basically, if you read one of the reports that are put out by the financial entities. So we're gonna go down now into price. So taking this from JSC today, uh, you notice that Fosrich had a dip. So Fosrich's current price is $14.06. And what did I show? When I showed the enterprise value at the time for the 9-month period, it was $12.78. So, and at the time, the market price at that time was only $8. It's now gone to 14. So it might possibly be that this price is way more than the enterprise, is no more than the enterprise value, not way more, but no more than the enterprise value. But it is a justifiable price if Fosrich puts out that they have had a really good year of performance when you do all of the calculations, because things change. So this might look overvalued now to you, but when you plug in all of the numbers, everything changes and the company now becomes actually undervalued based on how much net profit they made and how that net profit stacked up to cash flow and so forth. All of the indicators I just went over. So we see that the price is at $14.06. It actually had a dip today by about 9 cents. This is the closing price, by the way, right? And also it shows that that dip is basically 0.64%, or what they would call, is this would be 64 basis points. Let me not confuse. Let's forget about that. But 0.64% dip, right? You can also see that Fosrich has decent volume in terms of the bars that are there. I'm sorry that this didn't take the volume bar, but I'll show you actually in the chart about this that I did, the dashboard that I did. So this becomes more clear to you. So this is price, this is volume, and as you can see, the price has pretty much been flat. So it actually did touch 15 and then it dropped back. So it's basically been running along. So this price is actually lower. Prior to that, which was out in January, early January, it was much more below. So this will just look like about 12, right? But we don't have to guess. The next thing that we can look on is how the price has moved. And the range for the price today is anywhere between, this is a low of $13.65 and a high of $14.30 today. And then we have a 52-week range, which is for the year. It moved from $4.05 as a low to $14.95 as the highest. This is pretty good return if you had bought in at $4.05, right? And then these are the units that has moved over the 52-week range, ranging from low to high, as low as 250 and as high as 7 million, right? And it shows you each of these ranges what the percentage changes in terms of how it has grown. So I'm gonna move from this for a second to show you what I did for, and I will make this my disclaimer, because what has happened the last time is when I showed this, I was immediately asked, "OTK, are you willing to share this one?" I'm sorry, but this particular one is entirely built for purposes of this analysis only, and or the analysis in general done by me, right? So what I'll show you how Fosrich now stacks up to the entire market that I've done. So a lot of this is averages. In terms of everything has been taken on average price or an average indicator. So we're gonna take a look now at the just bring up the right sheet. Right. So we're gonna take a look now at Fosrich in comparison. So the entire market. Let me see how this looks. It doesn't look small. It looks like everybody can see that properly for the most part. I don't want to make it too big because then I start to lose the dashboard of itself. So let's see how best we can work with that, right? All right, so we kind of losing the dashboard. So this is the entire stock market, right? What am I looking at from left to right? From left to right, we have on this side is the average price to book value of companies. Bottom is the average earnings per share on a projected basis and on the 12-month basis. In the middle, we have the volume for the companies. And then we have on the right side, we have the average price to earnings ratios. And for those who know me, they know that I like to calculate what is called the Buffett's margin of safety, which is a combination of the price earnings ratio, so price to book value, and it gives me a figure. And I like that the figure is supposed to be below 22.5. So as we're looking at the sheet, pay attention to that. And this dashboard of how it is. So, as I said, this is the entire market. Everything is here. All of the companies that fall under the categories of tourism, equity funds, etc., so forth. As I said, Fosrich falls into retail. So let's pull up the retail section, see what happens there. So in the retail section, the average price to book value of the retail section combined of all the companies, and these are the companies over on this side: 138 Student Living, L.E.A.R.N Trading, Tesco, Montana, Jetpan, etc., etc. They combine to give an average of 4.59. So normally you notice, you heard in the first part of the presentation, I said that the analysts normally like to compare the company to their peers or to the market. So the average price to book value for the retail sector, as I have it calculated here, is 4.59, right? In terms of the figure. With respect to their earnings per share, it is 28 cents. Basically, that's a dollar value. With respect to price to earnings ratio, it is 24.74. And with respect to volume, or the volume figure, I'm sorry you can't see that better. I should change this to white so that the label is seen better. But for now, just to point it out, it's actually saying 221,796 is the average volume. And my margin of safety figure, which is egregiously high, is 167, as it should be at 22. And all of the companies combined basically give this. So now that's the retail sector in total. Let's get granular and let's look on Fosrich. Well, let's first look on what the junior market does, which is what Fosrich is in. So we jump down into the junior market, and the average price to book drops down to 4, goes to 490, 4.9, sorry. The EPS goes to 26 cents. We have a average volume of 238,000 units, and we have a margin of safety. Once again, it's still high of 179, and a PE average of 26.04. So how does Fosrich stack up to these companies in the junior market, which is a part of in the retail sector? Fosrich by itself. So let's uncheck that, and you'll notice how it moves. So, second, putting in Fosrich, it goes to 621. Fosrich's price to book value. What this means is that Fosrich's market price is 6.21 times higher than its book value. Its book value, its intrinsic value in terms of if you take the company, what its shareholder equity is, and put it into that form of doing the calculation of that form of actual price, intrinsic value, what they call it, they term it as intrinsic value, right? It's 6 times more than it. With respect to their earnings per share, average earnings per share, and this is taken over the 2 months, January and February, right? So far, it is at 0.52. Um, volume is low so far for the month. I guess they would have someone with the average volume is 15,000 units. And then we move over to, and it's Fosrich that's doing a very high margin of safety, 178, right? And the PE ratio is 28. So this margin of safety calculation is being obtained when you put the PE ratio to the price to book value. So there you have it. That's Fosrich, and that's the price, market price of TC of 14 today. Drill down even more to look on the entire performance against the entire market and then against their sector or segment of the market itself. Then there is one more section which has to do with the actual price of Fosrich. So let's see how that stacks up. This one I can make bigger. So this is with respect to how Fosrich's average price, the average price of Fosrich over the period January to February, how it stacks up against everybody else. So pretty much, let's drill down again. If we go retail, you see that in the retail sector, regardless of if it's junior market or main market, right? The price is basically, let's see now, in the month of January, price, the average price is what, 508 for the entire retail market, whether junior or main, and 594 in the month of February. When you get down to the junior sector, it moves to 605 for February, 511 for January. And when you move to Fosrich itself, Fosrich is easily outperforming everybody with their price, which in the month of the average price for the month of January was $12.57. And I will make this bigger the next time, but $12.57 is the price currently. And then for the price for February, that is $14.28. Right? So that's basically Fosrich in a nutshell for price. And what has been going on with their price of itself in how it's going. So I guess that would do well for the traders, basically to understand. And traders would like that. As you know, I'm not a trader, so but I still look on as much indicators as I can. So with that being said, we come to pretty much what is wrapping up in the presentation about Fosrich, and that is any news that is upcoming. So there are two things that, as I was digging through, I thought very relevant for Fosrich. The first one, and this is very impactful for those who know. So everybody who knows the junior market, you know that when the company lists on the junior market, there's a period of no taxation, right? That is afforded to them. So they have a 10-year tax free, of which the first 5 years they don't pay any tax, and in the next 5 years they pay half tax. Fosrich is about to move into the part where they pay at least 50% or half the tax and the normal tax that they would normally pay, right, in 2022. Now, I don't know when. We can find out, but it's happening this year. That is a line item that impacts their revenue under the taxation line item, and it comes just before net income, whether it be profit or loss, and it also impacts the balance sheet and also impacts the cash flow statement. So going forward, after 2022 is done, whenever it is implemented, every single year for the next 5 years, Fosrich will be paying at least 50% of what would be their normal tax rate on on the revenue, etc., or net profit, sorry, when it is derived, right? So that's the first piece of news. And the second piece of news is the expectation of Fosrich's audited financials. So basically, it's a calculation based on how the junior market is supposed to report. I'm expecting that we should be seeing Fosrich's audited financials of 2021 out by February, at the end of February. So the last one was put out on the 26th of February. So it's either supposed to be at the end of February or um, before that point, right? And there thereafter, that's what to look out for. So those are the two primary sets of news, and of course, all of this information that has been presented was achieved from the Jamaica Stock Exchange site. So everybody can find it at JamStockX. Now I'm going to drop out of the share to actually show you where you can find it. I have it up. Um, it's actually the same window. So Fosrich. So JamStockX, you will find Fosrich under the section of investment. So just look for instrument lookup under the trading section, normally at the bottom of the page, and just type in Fosrich. So here is the entire section of Fosrich. You can see the performance. These are the quarterly earnings. As you can see, 2021, the quarterly earnings of Fosrich outperforms 2020, which is why I said, let us see what the 2021 looks like. And for the annual earnings, you can clearly see that it was better in 2020 than 2019, which with a quarterly earnings that looks like this, we can expect that it's supposed to be higher than 2020, right? So that is that. And then, of course, as I said, you can find all of the rest of things. So I took all of my calculations, but my calculations are not in the audited financials, but the figures for the audited financials to do the calculations are found. I used the audited financials, and I also used the last quarterly financials. So here they are. So audited financials, but that's the report. That's the report for the 2020 of itself, the annual report. But this is the audited financials of 2017. This is for 2019, 2020, and then the last two are the Q3, which is the 9 months for 2020 and for 2021, pretty much. So that's it. That's the presentation of itself of Fosrich, how it was analyzed, and the review of the company. As I said, hope this definitely helps to give you better insight in terms of how, if you were thinking about investing in the company, what you should be doing in terms of looking into those indicators past just the things of, oh, the revenue looks nice or the gross profit was X, etc. Getting a little bit deeper. So I am now going to open up the floor for some questions, and I did see some questions pop up in the chat. So let me see, admin, if you can give me the first question that actually came up, I will go over what I saw as I scroll through. Let me see. Okay, so as it relates to equity versus debt, touching on that again, right? So that was straightforward. Straightforward, but it's for understanding. With respect to equity and debt, for me, as an investor, shareholder, and potential shareholder or shareholder, fair disclosure, I don't have password. Um, but potential shareholder, I was taught to look for a company that has equity that is either above or in the same line as the total debt of the company. Because, right? Because if you have ballooning debt and limited equity, you as a shareholder, if the company was to go into, say, for instance, bankruptcy, you have nothing to get because they have to satisfy their debtors first, right? or you have very little to get, I should say. And you have to remember, you're battling against, depending on how many shares you hold, that's the payout you're going to get. So if you really don't have that much, and the company was to become insolvent and then wind up, then you really would not be able to basically get anything. So that's the correlation between equity and debt for me. I like to ensure that equity is higher than debt. And there are companies, by the way, that have equity that is higher than their total debt, right here on Jamaica Stock Exchange. And that's a very positive thing to see, in my opinion. All right, so the next question we have. I normally put up the YouTube sites. I'm not.
Yeah, I'm not seeing any other questions really.
Oh no, wait, that's not true. Hold on a second. There was someone wanted to go over, or we were revisiting that, right? Okay, we're revisiting equity versus debt, etc. Right. And there are no questions out in YouTube land.
No, no. But as usual, if persons have questions, post them under the video and we'll get to it, or just ask it in the Telegram group as usual.
Okay, great. Well, I'm glad if there are no questions, that means that my presentation was very concise and clear. So that's great. All right, so in truth, yeah. So for those who, as I was saying, for those who have any other questions, when you review, when you share, right? And for those who will see this afterwards, when it's shared, if you have any questions, you can post the comments under the video in the YouTube um, chat of itself. You can also please find us on our Telegram group. Definitely, we have a lot of this being discussed. This is the kind of talk. So we are on Telegram, we are on Twitter, we are on Facebook. Reach out to us on any of those mediums. We are more than happy to share the information, because that's the only way that you become better investors. That's the only way I become a better investor as well too, by being challenged with your questions. So correct if I said something that was incorrect, or clarify something that was said. So yeah. So with that, everyone, I hope you all. Well, I'm seeing that some person said was a very effective presentation. So I'm hoping that you all enjoyed it, and you will review it more and more, because it's the same thing for any other company, by the way. It's not just Fosrich. This is the same template, and I just keep repeating the template. I might add some new stuff, but at this point in time, based on what I'm looking at, I think I'm done. So it the structure of the review and how it will look will look pretty much the same way going forward. It's the same things that I'm going to talk about. I like looking on cash flow more than anything else, and then I like looking past just hearing about net income or gross profit, especially gross profit margin. There's no kind of full picture that is given, because all gross profit margin is when you remove the cost of how that revenue was made from the actual revenue. There's so much stuff that happens below that before we get to, again, the point that concerns you as the shareholder, which is your net income. If a company makes 3 billion in revenue, which is actually the situation that you saw for Fosrich. Not that they made 3 billion, but they made a lot of revenue. And by the time you get down to the net profit, it's minuscule. So for instance, they make 3 billion, and then all they're walking away with is $100 million. I have grave concerns about that. And I start digging through line items to see what caused that, and how can they improve. How is there a possibility? I like to see a company getting more efficient every single year, like that. You should too, as an analyst, as somebody who is vested in these companies. This is not just a stock ticker. You're not buying, I always say it all the time, you're not buying just a stock. You're buying a piece of a company as if you own it, and you must treat it as such. Or you should treat it as such. You don't have to, but you should. I treat it as such. So henceforth, I think you should as well too. So once again, guys, thank you for tuning in. Thank you for giving us the time. As we say again, Disclaimer, this is not financial advice. We're not financial advisors. This is educational purposes. Hope it was educationally informative, everyone. Like the video, share, subscribe, and chat with us on our various mediums: Telegram, Facebook, Twitter, and we also have LinkedIn as well too. So therefore medium, right? To find us. And you guys have a wonderful evening. Take care.